Have you ever scrolled through the news and seen a headline about a massive, profitable company paying surprisingly little in taxes and wondered, how is that even possible? It feels unfair, right? But what if I told you it's often completely legal? Today, we're diving deep into the world of corporate finance to uncover the real reasons why big companies can legally pay less tax. It's not about secret loopholes or shady dealings. It's about understanding the rules of the game, a game that's designed to encourage certain behaviors. First, let's get one thing straight. The tax system isn't just about collecting money. It's a powerful tool governments use to steer the economy. They create a complex web of rules, incentives, and deductions to encourage businesses to do things that are good for the country, like creating jobs, investing in new technology, and boosting economic growth. Big corporations have armies of accountants and lawyers whose entire job is to understand these rules inside and out and use them to their full advantage. It's not about avoiding taxes, it's about tax planning. Think of it like a game of chess. The government sets the board and the rules, and companies make their moves accordingly. They're playing the game exactly as it was designed to be played. So, what are these moves? The most fundamental concept is deductions. Imagine a company makes $1 million in revenue. They don't pay tax on that full million. Instead, they first subtract all their legitimate business expenses. This is a crucial point. We're talking about things like employee salaries, office rent, utility bills, marketing costs, and the raw materials they need to make their products. Each of these expenses reduces their taxable income. So, if that company has $800,000 in expenses, they're only taxed on the remaining $200,000, which is their profit. This makes perfect sense, right? You should only be taxed on what you actually earn. For large corporations with thousands of employees and massive operations, these deductions add up to enormous figures, significantly lowering their taxable income right from the start. Now let's talk about a more complex tool, depreciation, when a company buys a big-ticket item. Like a new factory, a fleet of delivery trucks, or expensive machinery. They don't deduct the entire cost in 1 year. That wouldn't accurately reflect how that asset is used over time. Instead, they use depreciation. This allows them to spread the cost of that asset over its useful life. For example, if a company buys a machine for $1 million that's expected to last for 10 years, they can deduct $100,000 from their taxable income each year for those 10 years. This is a non-cash expense, meaning no actual money leaves the company's bank account each year for depreciation, but it still reduces their taxable profit on paper. For companies that are constantly investing in heavy equipment and infrastructure, like manufacturing or tech firms, depreciation is a massive factor that can drastically lower their tax bills year after year. Another powerful strategy is carrying forward losses. Business isn't always a straight line up. Companies have good years and bad years. What happens when a company loses money? Let us say a startup spends a few years investing heavily in research and development and operates at a loss. The tax system allows them to carry those losses forward. This means that when they finally do become profitable, they can use those past losses to offset their new profits, reducing their tax liability. For instance, if a company lost $1 million last year and made $3 million in profit this year, they can use that prior loss to reduce their taxable income to just $1 million. This rule is designed to help businesses, especially new and growing ones, survive the volatile early years. It encourages risk-taking and long-term investment, acknowledging that it often takes time and money to build a successful enterprise. For large corporations that make huge, risky bets on new products or markets, this can be an incredibly valuable tool. So, why does this system seem to favor big companies over small businesses or individuals? It's a matter of scale and resources. An individual's deductions are usually limited to things like mortgage interest or charitable donations. A small business has its own set of deductions, but they're operating on a much smaller scale. A multinational corporation, however, operates on a global scale with complex supply chains, massive investments, and operations in different countries, each with its own tax laws. They have the resources to hire the best experts to navigate this complexity and take full advantage of every single deduction, credit, and incentive available to them. From R&D tax credits to incentives for building factories in specific regions, it's not that the rules are different, it's that the ability to leverage those rules is vastly different. The complexity of the system itself creates a barrier that's easier for large, well-resourced entities to overcome. Now, you might be asking, why would a government design a system that allows this? It comes down to a simple, powerful idea: encouraging investment and growth. When a company invests in a new factory, it creates construction jobs. Once it's built, it creates manufacturing jobs. It buys materials from other businesses, supporting a whole supply chain. When a company invests in research and development, it can lead to innovations that benefit everyone, from new medicines to more efficient technology. Tax incentives like depreciation and R&D credits are the government's way of saying, hey, if you invest your money back into the economy in ways that create jobs and drive progress, we'll give you a tax break. It's a trade-off. The government forgoes some tax revenue now in the hope of fostering a stronger, more prosperous economy in the long run. The debate, of course, is whether this trade-off is always worth it and whether the balance is right. But the underlying principle is to use the tax code as an engine for economic activity. In the end, the tax system is far more than just a mechanism for funding public services. It has a deeply intricate framework of incentives and regulations designed to shape corporate behavior on a massive scale. The reason big companies often pay less tax isn't because they're breaking the law, but because they are masterfully playing a game with rules designed to promote investment, innovation, and growth. By understanding how deductions, depreciation, and loss carryforwards work, we can begin to see the logic behind the headlines. It's not about secrets, it's about strategy. Understanding these systems gives you leverage, not just in business, but in understanding how our world truly works. Thanks for watching. And if you found this breakdown helpful, don't forget to subscribe for more insights into the systems that shape our economy.